All right, hi everyone. Welcome to today's webinar where we'll be talking about building your trading strategy, position trading, right? So this webinar series is brought to you by IC Markets Webinar. Well, just a couple of minutes early, so I just want to make sure while we wait for everyone to tune in, just want to make sure you guys can see my screen. You should be looking at the first page of the slides, IC Markets Webinar, 25th July. You should see my laser pointer as well. I just want to make sure you guys can hear me loud and clear. Hearing, all right, thanks, Dixon. All right, everyone. Thank you for tuning in. All right, okay, audio, visual is all good. All right, perfect. That's great. I think we'll be ready to start in a minute or two. Okay, before we get to that, let's just look at Forex Factory, right? So you guys know we have a heavy calendar this week. Right, we have three major central banks reporting or announcing their interest rate decisions, starting with the Federal Reserve tomorrow. Okay, just a quick note, I'm on Forex Factory and my time is on GMT or UTC plus 0. So tomorrow, 26th July at 6 p.m., the Federal Reserve will be announcing their interest rate decision, where they're very likely going to raise interest rates by 25 basis points to bring it up to 5.5, followed by the press conference by Chairman Jerome Powell at 6:30 p.m. GMT. So during this press conference, it is also a market moving event, as the markets and traders will get to hear what Jerome Powell has to say with regards to uh, the insights from him and his FOMC members, as well as the outlook for future interest rate projections. Right. Following that, we have the ECB on 27th of July, Thursday, 12:15 p.m., where the ECB is going to also raise interest rates by 25 basis points to bring their main financing rate up to 4.25%, followed by the press conference by President Christine Lagarde at 12:45 p.m. GMT. And to round things off on Friday, we've got the Bank of Japan announcing their interest rate decision on Friday, 28th of July. All right, do take note that the time is tentative because the Bank of Japan does not officially disclose the actual time that they're going to release their statement, but generally it does happen around 4 a.m. GMT. So do look out for that. Of course, plus minus 30 to 60 minutes, but generally based on past meetings, they've released their interest rate decision at about 4 a.m. GMT, followed by the press conference, which starts about an hour or two after that. All right. Okay. Right. We've got everyone in as well. Right. All right. Hi, Desiree. Good evening. All right. Thanks, Dixon, as well, for making sure audio is loud and clear. All right. We'll head back to the slides. And of course, we'll start off with the disclaimer. Right, so do take note that this is a marketing communication and does not contain and should not be construed as containing investment advice or an investment recommendation or an offer of or solicitation for the transactions in financial instruments. Do take note that also the analysis contained herein does not constitute a personal recommendation and does not consider your personal investment objectives, investment strategies, financial situation, or needs. And also do take note of the risk warning that comes with trading CFDs and Forex. They carry a high level of risk to your capital, and you should only trade with money you can afford to lose, right? Okay. So my name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group, where we've been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. So this webinar series is brought to you with a special partnership between IC Markets and Everest Fortune Group. All right. So today's webinar is all about position trading. So here's the agenda. So of course, we'll start off with the basics. What is position trading, and how? What are the main key points to take away from this, and how does it differ from other trading strategies? Then after, the second point we'll be looking at is fundamental and technical analysis. How much of it should we incorporate? What are the key fundamentals to look out for, and what are some of the key technicals that we can use for position trading? Then we'll also look at examples of position trading. And finally, we'll round up with building the strategy and putting it into practice. All right, okay, so what is position trading? Okay, basically it can be simply defined as a trading strategy, or which is long term, right? Okay, so basically it is a long-term trading strategy that can last from a period of several weeks, months, or even longer, right? So this could be a single position or a handful of positions that will last from 3 to 4 weeks as a minimum, and going up to a couple of months, or perhaps even over quarters as well, so 1 or 2 quarters as well. So the aim is to profit from long-term trends rather than short-term price fluctuations, right? Naturally, if you're looking at longer-term trends, the profit potential is greater, but so is the risk, right? As long as we are aware of how we want to set up our risk management, just with any strategy, there's always a risk, right? Okay, so as we mentioned in the previous slide, it's a relatively long-term strategy that incorporates trend-following concepts, right? Because we want to capture the big theme, or the main overarching theme, and the main trend, right? Whether it is rising upward strongly, we are in a corrective phase where we have a long downtrend, or it just could be even a sideways trade, right? A sideways position. It is not as time consuming as other strategies, as position traders take on very few trades. As I mentioned at the start, it could be just less than a handful of trades, 1 to 3 trades over maybe every quarter, for example, and then which will probably add up to maybe just under double digits over a year, right? Okay, so we identify the entry and exit prices in advance, and of course with tight risk controls, with stop loss orders as well for risk management best practice. And also, as I mentioned, the main driver would be a fundamental theme that is the predominant focus of analysis, right? So the main idea is to identify major themes in that particular asset class. It could be forex, it could be gold, oil, or even equities. Right, okay, so how much fundamentals versus technical should you use? Right, so in general, position traders use a combination of fundamental and technical analysis, and in general, more emphasis is placed on the fundamentals, factors such as macroeconomic factors, general market trends, and historical price patterns as well. And from a technical aspect, key support or resistance levels are identified. There can be several ways to do this. You could use Fibonacci retracements, projections, extensions, expansions. You could also use horizontal overlaps, looking at key significant resistance and support levels on like a daily, weekly, or even monthly time frame. And also you could also use the moving averages, right? Typically we would use the 50 and 200-day moving averages on the daily time frame. Okay, so what are some of the key macroeconomic events to look out for? Okay, so if you're trading currencies, then naturally we'll be looking at interest rate decisions by the central banks. So basically we are looking at monetary policy. We want to see which central banks are raising rates, cutting rates, or keeping them on hold. And naturally we would want to look at what the 3 biggest central banks in the world that are doing. Basically that would be the Federal Reserve, the European Central Bank, and the Bank of Japan, right? I think we can all conclude that these 3 central banks are the biggest players, and they will have the most impact on currency markets. And also, we're also looking for deviation from normal monetary policy action. Okay, so what do we mean by deviation? It could be a case where a central bank was previously hiking aggressively, and then suddenly they pause and then they pivot and start to cut aggressively. So that's one example of a deviation. Another example could be central bank intervention, right? So that's when a central bank intervenes in the open market by either selling or buying their home currency, right? So this will be explained in a good example that occurred last year in October for the dollar yen, or rather for the Japanese yen, which this intervention measure was carried out by the Bank of Japan. Also, is also key to take note of divergence in monetary policy. So what do we mean by divergence in monetary policy? So say we have we look at all the major central banks. We look at the Federal Reserve, and for example, we look at the Bank of Japan. So since 2022, we know the Federal Reserve, the ECB, the Bank of England, and most other major central banks were aggressively raising interest rates to combat inflation. However, the only one bank that did not do so was actually Bank of Japan, right? They were the only major central bank that kept their interest rate at negative 0.1% throughout 2022 and right up till now as well in 2023, right? So in an environment where we had rapidly rising inflation and the rest of the major central banks were aggressively hiking interest rates, Bank of Japan was the only central bank that kept its interest rate at negative 0.1%. So this is what we mean by identifying divergence in monetary policy between two central banks, right? So this will also be shown in a good example for the dollar yen and of course for the euro yen as well. All right, with the main theme, running theme from starting in 2022 was inflation. So this is the current hot or rather key macroeconomic data point that actually affects markets very strongly. So changes in inflation growth in the current time or the current period is very important. Other macroeconomic data to look out for would be changes in GDP numbers, PMI figures, non-farm payrolls, and other factors as well, right? You have also industrial production, retail sales, and so on and so forth. But what seems to be what was dominating the theme last year was inflation growth. So looking at CPI, headline CPI, which is the consumer price index, the core CPI, also looking at PPI, which is producer price index, which measures inflation in the wholesale sector. So looking at the headline PPI and the core PPI, right? So these were the main macroeconomic factors that markets were paying attention to very closely last year and this year as well. And also the focus is now on employment figures as well. So despite, although the Fed has raised interest rates very aggressively, the labor market has managed to stay pretty robust. We see non-farm payrolls adding jobs on a monthly basis at a pretty healthy level. We don't see unemployment claims spiking up yet. So overall, although economic activity does look like it's slowing, as we'll see in the charts coming up, it does seem the labor market has held up pretty well given the tight monetary conditions. Right, so these are some of the macroeconomic factors that are currently very relevant in today's environment. Okay, key technicals to look out for. So we can use major support and resistance levels, right? So we look at the daily time frame, weekly and monthly time frame, and try and identify major overlap and support and resistance levels. We can also use Fibonacci retracements in order to find support levels and potential resistance levels, or not only retracements, but of course you can use projection, extension, and Fibonacci expansion. And of course, I mentioned we use the moving averages as well. Typically, the 50 and 200-day moving averages are used on a daily chart. And when you have a environment where you have a crossover of the 50 and the 200, it is called the golden or death cross. So golden cross means is when the 50-day moving average crosses above the 200-day moving average, this signals or confirms a bullish trend. Conversely, if the 50-day moving average crosses below the 200-day moving average, this is known as a death cross and typically signals a bearish confirmation, right? So we'll look at this in the charts as well. And also we can use Ichimoku cloud, the Ichimoku cloud indicator as well, to see where major resistance and support levels or zones are, rather, not levels, but zones. Okay, right. Okay, examples of position trading. So in 2022, we've had a couple of factors or themes that enable us to identify potential identify potential trade ideas for position trading, and also we have some of the themes that are sort of repeated in 2023, along with new theme, which was the AI driven mania that started at the start of this year as well. Okay, so we'll start off with I guess going into 2022 and what were the main fundamental themes that caused price action or caused currency markets to behave in such a manner. And then we'll also go into 2023 and see how certain themes have driven equity markets as well. Okay, so just in general, in 2023, we've had the AI-driven growth in equity markets. We've also seen PMI activity rebounding relatively strongly across major developed economies in the first half of 2023. And this is also something that's interesting to note, that although central banks have been raising interest rates aggressively throughout 2022 and continue to do so in 2023, financial conditions have somewhat actually become a little loose over the last 6 months or so. I'll explain this in the next few slides once we get into it. And now this year, we can definitely see inflation decelerating, right? So we saw inflation accelerating rapidly in the first half of 2022. And from the third quarter onwards, roughly, we saw inflation decelerating. And okay, now if we go rewind the clock and go into 2022, of course, inflation accelerating rapidly was the main driver for central banks to aggressively raise interest rates. And we also touched on monetary policy divergence earlier, right? We saw, we've seen major central banks like the Fed, ECB, Bank of England raise rates aggressively, while the Bank of Japan, apologies, kept their interest rate at negative 0.1%. So this results in monetary policy divergence between two central banks. And of course, we also had Bank of Japan intervention in the open markets in October of 2022. We'll look at this as well. And also after the intervention, basically it was the intervention that led to an environment where we had looser financial conditions, which I'll explain in detail as we move on. All right, okay. Right, okay, so just going back, okay, so this chart shows the US composite PMI chart. So PMI is Purchasing Managers Index. Okay, so it's a survey that measures the level of manufacturing and services activity in the respective country, right? So this survey is done across major, actually not even major, across most economies, ranging from developed markets to emerging markets as well, right? So the composite PMI, right? PMI stands for Purchasing Managers Index, is a survey that measures the level of manufacturing and services activity in a particular country. So it's a combined index that measures manufacturing and services growth or activity. Okay, so it's in a general sense, maybe for those who are, just to have a quick recap, for those who may not be familiar with PMIs. So the 50 level threshold is an important, the 50 level is an important threshold. So if we have an index reading that's above 50, it means that this sector or this combined sector is expanding. And if you have the index reading that's under 50, like what we see here in 2022 and the first quarter 2020, when we saw COVID lockdowns, we saw manufacturing activity and services activity come to a halt. It dropped well below 50. And then as well as in the second half of 2022, we saw overall economic activity in the US contract as well. Okay, so just remember, an index reading below 50 signals contraction, an index level above 50 signals expansion. Now, because we are looking at the composite reading, it's just telling us, the composite reading tells us the overall activity for that country, right? And now in the next slide, as I mentioned, the composite is made up of data from the services PMI and the manufacturing PMI. So just remember, composite just means the combined reading or combined output from the manufacturing and services sector. So now we are breaking down the composite into services and manufacturing. So we're going to look at services first. Right. So naturally, after the COVID lockdowns, as economy started reopening, activity started picking up. So naturally, you see a big, strong rise in expansion in services PMI as well as manufacturing PMI numbers. And due to higher interest rates starting in 2022, we saw economic activity in the second half start to slow down, right? Although it was still expanding. Remember, reading above 50 means it's still in expansion territory, but it means that the rate of expansion is slowing down, right? So as interest rates rise, perhaps businesses, whether they're manufacturing sector or services sector, maybe hold back on capital expenditure, hold back on expanding their businesses and operations and so on and so forth. So we can see the demand pull back as well, and then that would naturally lead to the production or the output rather for the services sector retreat as well. So in August of 2022, the services PMI bottomed, and it's also, if you look at the composite, it's also the same date which the composite PMI bottom as well. So if you look very closely, we can see that the services PMI actually is very similar to how the composite PMI is moving. The composite PMI, the latest flash readings were just released this week. So on Monday, just yesterday, basically, we had the flash PMI reading for the US and EU released yesterday. So this peak here is for the month of May, then June was somewhere here, so about 54, 53. And the flash reading for the month of July for the composite reading came in at 52. And for the flash reading for services PMI for the month of July came in at 52.5. Right, so we can see that services PMI is actually just pretty much mimicking composite. So we can say that because the composite is made up of services and manufacturing, the services sector has actually been pulling up overall economic activity. Okay, so why do I say it's been pulling up services? Services has been pulling up overall economic activity because we can see for the US manufacturing PMI that this deceleration activity has remained in contraction territory, although it did rebound to peak above to enter expansion again, but it actually reversed to drop lower. Right, so this is how we can use PMI report to see the level of activity for that particular country and see whether are we in a period where economic activity is accelerating rapidly or is it decelerating. Right, okay, so now this leads us to inflation also, right? So this chart is from the Bureau of Labor Statistics. So if you just, okay, I'll just maybe give you an example of how to access this chart. You can either look for it on Forex Factory. So if you see CPI data event coming up here, you can click on that folder and it'll take you to the latest. If you click on latest release, it'll take you to their website, or you can just simply type BLS, type CPI, and the first result is the page you want to go to, which is CPI Home, US Bureau of Labor Statistics, Consumer Price Index. And then we click on charts. And then we'll look for the category that says 12-month percentage change, Consumer Price Index, selected categories past 20 years. Click on Go. So you'll get the year-over-year data for Consumer Price Index, which in this case, all items refers to the headline reading, and the core CPI would refer to all items less food and energy, right? So this is how we can access these charts to see how inflation is, whether it's rising rapidly or is it decelerating, as was the case since June of last year. All right, so going back to the slides. Okay, so we can see CPI peak in June of 2022 and has been decelerating very rapidly, whereas core CPI, which doesn't consist of food and energy, which would consist of other categories which mainly make up shelter, which covers rent and home prices, and also covers services and medical care services as well. So that makes up core CPI, and you can see that has not fallen or retreated as sharply as the headline CPI. So this is one of the primary reasons why the Federal Reserve and other major central banks are reluctant to cut rates. Right? Many analysts and economists were predicting that because the headline CPI reading was retreating very sharply, coming close to the Fed's target of 2% year over year. Because of this scenario, many were predicting the Fed or expecting the Fed to start cutting rates this year. But in fact, they've slowed down. The Federal Reserve has slowed down the pace of interest rate hikes, and rather they're more likely to keep rates elevated rather than increase them. So, but most likely this week, tomorrow, they're definitely going to raise interest rates, and moving forward, they may continue to hold rates. So they would really like to see the core reading retreat as sharply as the headline reading. And if that starts to happen, then we can probably enter a phase where the Fed is just going to keep interest rates on hold and maybe eventually start gradually cutting them early next year. Right, okay, so this chart is I find this very useful. So basically this chart helps me to look at the prices category of the ISM manufacturing PMI data and services. So if you see the red line takes the prices average. Okay, ISM, for those who are not familiar, right, I'll just quickly take you. ISM is the Institute of Supply Management in America. It measures business activity growth in the US, basically the manufacturing sector and the services sector. So if you click on charts, what do I mean by prices? It is actually a sub-index in the main manufacturing PMI that helps us to identify the level of inflation in the manufacturing sector. And similarly, it helps us to measure the level of inflation in the services sector. So if you look at it, prices are still, for the services sector, are still expanding, but they are expanding at a slower rate. Remember, any reading above 50 indicates expansion. So by expanding at a slower rate, whereas manufacturing has actually been decelerating pretty hard. So if you look at prices for the manufacturing sector, it actually decelerated pretty hard or quickly, and then it's remaining in contraction territory. So let's give you some background about how ISM prices average is determined. So if we can see, if you observe the red line, which is ISM prices average, it actually tends to lead CPI year over year change, so the headline CPI reading. So ISM prices on average, as you can see here as well, back in 2009 and also after it peaked in 2011, that this combined average index tends to lead CPI. So when we see ISM prices rising rapidly, we can expect CPI to follow suit as well, which was what happened, right? And in this case, as we know, because in 2022, the Federal Reserve had to raise interest rates to combat inflation, we should be looking out for potential increases in the value of the US dollar versus its peers. And similarly, as ISM prices, the average of ISM prices peaked and started to retreat, we can see that CPI readings peaked 1 or 2 months later and followed suit as well. So ISM prices average reading gives us a very good indicator, or leading indicator rather, for the direction of CPI or inflation in the US. So this is how something that we can use to try and sort of anticipate where inflation is heading. All right, hi Desiree. Okay, so where do I get these charts? Okay, so basically for all right, okay, for this is in TradingView. Okay, so if you see on my screen now, US Composite PMI, US Services PMI, and US Manufacturing PMI. This can all be found on TradingView as well. So if you do look here, where my highlighter is currently circling, if you type US COM PPI, I believe, or if you just type US Composite PMI, it will give you this result in TradingView. Similarly, for services, it is US SPMI, and for manufacturing is USM PMI, right? So if you type this into TradingView, you can get the chart, or if you do just Google for it, it will take you to the actual report as well. So maybe I'll just show you an example. And for ISM manufacturing services, just type ISM PMI, and you will see ISM report on business, and you can see the monthly chart that comes out, and you can also see historical reports as well, and the sub indexes or sub indices readings are found here as well. And it also breaks down for you the various indicators, various indicators and sub indices. So also for just if I type US PMI, right, and if you look for S&P Global, okay, S&P Global is a company that releases or that conducts the surveys and releases them on a monthly basis. So if you click on PMI calendar here, and as we mentioned at the start, yesterday we had why is this? Hang on. All right, hang on. Just give me a second. Wait. Okay. Yeah, click on view all, and we can see that yesterday we had US flash, US composite PMI release from the and also from the UK and Eurozone. So if you click view more, you can read up more about the state of the US economy with regards to manufacturing and services output in further detail here. Right? Okay. So now, right. Okay, so sorry, I'm just touching on key macroeconomic indicators that have been useful in building the idea for position trading and for 2022, and also how we can use it for 2023. All right, so I stopped here. And okay, similarly, you can do it for the EU as well. So you can see EU has actually, or rather, the composite reading is showing economic output in the EU has actually entered contraction territory once again. So we had a nice sharp rebound from the fourth quarter of 2022, pretty much going into the first quarter and middle of second quarter of 2023. But after that, we can see growth has now started to decelerate as well. And especially in the EU, growth has actually turned negative, at least from a composite PMI reading point of view. Right. Okay. We also touched on looser financial conditions, right? Okay. So basically, even though we had central banks, especially the Fed, continuing to raise interest rates from October 2022, they continued all the way to here. We can actually see bond yields fall and the value of the dollar index fall as well. Okay, part of this reason here is also explained by the intervention by the Bank of Japan. So as government bond yields rise, particularly, it's good to pay attention to the US 10-year bond yield. And when we see the US dollar, the value of the US dollar rising, which is reflected in the DXY, this means that monetary conditions are tightening. However, when we see this peak occurring here in October, and especially the dollar index retreating sharply, and we also see bond yields pulling back, this actually signals that monetary financial conditions are actually starting to loosen, right? So when that happens, this becomes quite favorable for equity indices or equity markets. So this is why around this period in October of last year, pretty much major equity markets had actually started to bottom and started to rise due to a combination of looser monetary conditions or looser financial conditions, and also, as we saw, economic activity if you just look at the composite level, economic activity actually picking up in the third and fourth quarter. So we had strong economic growth, or rather a strong rebound in economic activity and growth, combined with looser financial conditions, right? So do take note that although interest rates across major economies were still elevated, but because the value of the dollar index was falling, government bond yields were also retreating. This creates an environment where financial conditions are actually looser, which means that it's generally more favorable for equities. And combine that with a rebound in economic growth, we can see company earnings increase in this year as well. If you look at the Q1 and Q2 earnings of 2023, company earnings have increased, and we can also see share prices rebound strongly as well. So this is what we mean by looking at financial conditions, whether they are loosening or whether they are tightening, right? So despite what central banks are doing, a good indicator of whether we have loose or tight financial conditions is to look at the US 10-year bond yield and look at the value of the dollar index. So what we see in 2022 onwards, both of them rising sharply, that means financial conditions are tightening. That generally is not good for equity markets. And as financial conditions start to loosen, so bond yields pull back, dollar index falls, this generally creates a more favorable environment for equities. So this is part of the reason why we also saw major equity indices as well as individual names bottom roughly in the third and fourth quarter of 2022, and having a strong rebound in 2023. Okay, now going to examples, right? Okay, so we are talking about position trading, and so we have given a background of how we can use the macroeconomic data to factor in the direction of interest rate hikes and to factor in the value of the US dollar, right? So as the Federal Reserve raises rates aggressively, right, the level of the bond yield rises, and we can also expect the value of the US dollar to rise as well, right? So as you can see, this is my cursor here, we're 2022. So when we have the environment where we can see right, where should I start from? Okay, where we can see, right, inflation rising, we can see inflation rising. Oops, sorry. We see inflation rising, and as we know, if we are, this may be something new for many of you, so do take note of this. If you take the average of the ISM prices and you correlate it or you cross-reference it to the CPI year over year, you will see that this indicator or this reading tends to lead CPI. So we can actually have a leading indicator, a rather reliable leading indicator that tells us whether inflation in the US is going to rapidly accelerate, is it going to peak, and finally rapidly decelerate. So this is a very useful indicator to have. You can build it on your own just by going through this website that I've mentioned, right? So we can see how inflation rose rapidly, and when that happens, central banks have very limited tools to combat inflation, and one of them is to raise interest rates. So by being aware of this macro environment, we can start to build long dollar positions, right? So when we know inflation is rising rapidly, ISM prices average is also rising rapidly, and the Fed has communicated to the public and to the media that they are going to raise interest rates in order to combat inflation. And do take note, the first rate hike occurred in March of 2022. So and not only did they start in March, they started pretty aggressively as well. So I think the first interest rate hike was 50 basis points or half a percentage point, and subsequently all the next 3 and 4 hikes were 75 basis points. So it was very or rather extremely aggressive interest rate hikes, which caused bond yields to rise, as we saw, right? Government bond yields, this is 2022, this is April, so probably March is somewhere around here. Bond yields rising, the US 10-year bond yield rising very aggressively from 1.6% roughly going to as high as 4.2, 4.4% in October. Right, so when you see government bond yields rising rapidly, it's also very likely that the value of the US dollar is also going to rise, and that means the value of the dollar index is going to rise. Okay, so now we're going to use the dollar index as an example. So we have the daily chart. So this chart shows the daily time frame for the dollar index. I've got my indicators such as the Ichimoku cloud on, and I'm also using the 50-day moving average, which is highlighted, which is depicted in the blue line, and we've got the 200-day moving average depicted in the orange line. Okay, just to bring before I get into details, remember we talked about golden crosses and death crosses, right? So when we talk about, so here we can see a good indicator, a good example of a death cross, right? So that's when you get the 50-day moving average crossing below the 200-day moving average. But one thing to take note that price had already pulled back pretty rapidly even before the crossover happened. So what this tells us is that the golden cross, and specifically in this case the death cross, is actually a very lagging indicator. It basically is to me it's a super delayed confirmation indicator. So if everyone is just waiting on the daily time frame looking for the golden crosses and death crosses, you would have missed the move, right? Of course, here looking at the confirmation, you could still have identified a potential opportunity to short the dollar index, but you would have missed the majority of the move, right? Probably more than half of the move. So although it's good to use the 50 and 200-day moving 250 and 200-day moving averages, do take note that the death cross and the golden cross, which is the opposite of this, which means the 50 is crossing above the 200, is usually a very delayed indicator, right? It's not a leading indicator, it's not even a coincident indicator, it's actually a very delayed indicator, right? So just something to take note of. So we can see here, okay, for those who may not be familiar with Ichimoku cloud, is basically an indicator that tells us that basically if price is trading above the cloud, it means that price action should be bullish and should continue to remain bullish. Conversely, if it crosses through the bullish cloud and starts to trade below it, and then we see the bearish cloud start to form and price continues to trade under that cloud, that means we are in a long-term bearish move. So similarly, so price trading above the green cloud indicates a long-term bullish environment, and price trading under the red cloud indicates long-term bearish environment in general. Okay, so if we can see here, right, so let's just rewind the clock a little bit and imagine we are in March of 2022. We know inflation is rising. We know the Fed has communicated that they're going to raise interest rates quite aggressively. It should be signaling to us that, okay, the value of the US dollar and hence dollar index is going to rise rapidly. Actually, even before March, I think we can see government bond yields sort of price that in as well, right? So we actually saw throughout 2021, the US 10-year bond yield actually rising, right? And also the dollar index actually came off this low base of 90 back in middle of 2021 and started rising. So even before the Federal Reserve had actually started to raise interest rates, they probably started communicating this towards the end of 2021, right? Early end 2021, early 2022, that's when they were communicating to the media and to the public that they were going to start to raise rates. But actually, bond yields had already somewhat predicted or forecasted the rise in the value of the US dollar. So that's why it is quite important to take note of where the US 10-year bond yield trades, whether is it rising, whether is it trading sideways or falling, because usually it does provide a good indicator of where we can expect the value of the US dollar to go, right? So bond yields were actually already signaling beforehand prior to 2022 that the value of the dollar index or the value of the US dollar was going to rise. Right, so coming back to this dollar index chart, daily time frame. So March was when we had the first hike. And if you're a position trader, based on the fundamental data that we have been tracking, we would have been starting to build long dollar positions here, right? So basically around, what is this, 98, between 95, 96 and 98, seeing there's several factors that would contribute to a bullish case. We can see that price is trading above the Ichimoku cloud. We also have the 50-day moving average trading above the 200-day moving average, and both of them are sloping upwards. And we can see price continuing to rise. So given the macroeconomic backdrop, given the communication by the Federal Reserve that they're going to raise interest rates to combat inflation, we can see where bond yields are rising. This would be a period where we should be starting to build long dollar positions. Now, this could be via just buying the DXY instrument, or it could also be just looking to buy dollar yen, or also looking to short the euro dollar, right? So as price is rising, right, we can use the 50-day moving average as well, and a combination of the 50-day moving average and Ichimoku cloud to see whether this bullish trend is still intact. So of course, along the way, with any price movement, whether it's a bullish move or a bearish move, there are bound to be retracements, right? So at least on the daily chart with the combination, or on daily time frame with the combination of the 50-day moving average and the Ichimoku cloud, we can see that price is actually the combination of the 50-day and Ichimoku has provided a generally identified a decent support zone for the value of the dollar index. You can see here price didn't break through, but as in August onwards, we knew that inflation inflation had peaked in June, but the Fed was still signaling an increase in interest rates, and government bond yields were also still rising. We could have taken another entry level here as well to ride out the move. I mean, to build the move, sorry. Right, and we can also use Fibonacci retracement. For example, we could use the swing low here in March, and as price peaked in just after May, it started pulling back. We could also do a Fibonacci retracement. We'll do it on the charts later, right? And see whether do we have any Fibonacci retracement levels that actually supported or added as a third factor to the support zone for the 50-day moving average and also the Ichimoku cloud. Right. Okay. And now we'll just go to the dollar. Oh, sorry, this was dollar yen. So sorry. Yeah, apologies. So dollar index, we can see it actually price was well supported by the 50-day moving average and the Ichimoku cloud during the ride up. Okay, and then we had similarly for yen, dollar yen as well. Right. So okay, why did everything peak? Right, everything seems to have peaked in October, November. Right. Let's go back. We see the US 10-year bond yield peaking in October. Right, touching 4.4%. Stayed elevated for a couple of this chart is showing, I believe this should be the weekly chart. Okay, apologies, I didn't clarify. These two charts are on a weekly time frame, so we can see in the first week of March, basically, or second week of March, bond yields peaking and the dollar index peaking as well. So why did this happen? This happened because the Bank of Japan announced an intervention measure. Right. So what is an intervention measure? This is when a central bank comes into the open market and either buys or sells its currency. So the Bank of Japan's currency is the Japanese yen. So because we were in a rising inflation environment, and also because the dollar yen was rising rapidly. So do remember, when the dollar yen is rising rapidly, it means the value of the Japanese yen is getting devalued very strongly or very significantly. So if the Japanese yen is getting devalued very strongly, that would mean potential imports into the country are getting more expensive, and that would contribute or add into the inflationary pressures that most countries were facing. So that is why the Bank of Japan announced this intervention measures, right? So I'll just scroll down a little bit here, so we can see, okay, this article is from November of 2022, but actually there were many articles by CNBC, Bloomberg, and Japan Times, right, that actually documented the intervention measure by the Bank of Japan. And this should be signaling to us a major fundamental shift in currency markets, right, particularly from the Bank of Japan and the Japanese yen, right? So when this announcement came to light, and with the Bank of Japan intervening in the market, right, this should be signaling to us that there's a fundamental shift occurring in markets. So how exactly did the Bank of Japan intervene in the open currency markets, right? So if I go back to the charts, right, okay, so now I'm on dollar yen, right? So basically what they did, Bank of Japan is one of the largest holders of US treasuries and the US dollar, right? In terms of their foreign reserves at a global level, they have a large holding of US treasuries and the US dollar as well. So to intervene in the market and to buy back the Japanese yen to prop up its value, they were selling US treasuries, and they were also selling the US dollar. So the sales proceeds from this sale was used to buy the Japanese yen in the open market. So if the Bank of Japan is aggressively buying Bank of Japan is aggressively buying Japanese yen in the open market, that means the value of the Japanese yen is rising. And if the value of the Japanese yen is rising, that would mean dollar yen is going to actually start to fall. So we had a big central bank action, which was basically intervention, that should be signaling to us, okay, it's very likely now that the value of the Japanese yen is likely to increase versus its peers. And this is what we saw from October, November onwards. And we can also see that price had actually broken through a couple of key indicators as well, right? It broke through the 50-day moving average very cleanly, right? You can see this is a daily chart. It had a big one-day move here. It was in the middle of the cloud, and finally the cloud did offer some support as we saw price retrace a little bit, but eventually it also broke out of the cloud and started to trend lower. So by looking out for such intervention announcements, right? And you don't even need paid subscription services, right? Even your local finance newspaper would have covered it, right? It could be your national country's newspaper for the finance section, or even the free sections of CNBC and Bloomberg would have covered it and would have been able to catch onto this vital piece of information and then use the technicals to see that, okay, there has been a fundamental shift, and now I should no longer be going long, right? I should have probably exited my long positions here. So as we said, risk management is important. So as a position trader, you would be trailing your stop loss as well, right? And then when you hear this big intervention news and you see price reacting strongly, it is actually time to quickly exit any long positions that you may have had. Now the the environment has changed. We've basically pivoted 180. So now the dollar yen is going to fall rapidly, and because the Bank of Japan is also selling US dollars and US treasuries, that means the value of the dollar index is going to fall, which is what we saw here as well. Around the same time, you can see price action breaking through the 50-day moving average, breaking through the cloud as well, right? And if you had waited for the death cross confirmation, you would have missed out on this big move for both the dollar index and the dollar yen, right? So that is why I say the death cross or the golden cross is a pretty delayed indicator, right? I wouldn't rely on that to initiate a position, whether to the long side or upside, but rather it's a confirmation of where price is currently, or confirmation of the trend, right? To me, it's a trend confirmation, a delayed trend confirmation indicator. So, right, you can see price moving through the cloud, moving through the 50-day moving average based on the intervention announcement, And this is a period where we would be building short positions on the dollar index and also on the dollar yen, right? Now, similarly for the euro, although the central bank, both central banks were raising interest rates, we had the ECB raising interest rates, and we had the Federal Reserve, but the flows into the US dollar were way more significant than any other currency, which is why we also saw the euro dollar fall rapidly as well. And there were more pullbacks along the way for the euro dollar, but you can see that since March of 2022, it had broken through the cloud and the 50-day moving average and was trading lower. And then potential short entries, again, to build the position were marked by the 50-day moving average, right? Price came close to the 50-day moving average, barely touched the cloud a few times, but proceeded to retreat and make lower lows, right? So we can see how we can use these indicators given the macroeconomic backdrop, given the fundamental backdrop, and also monetary policy actions, of how you can build the short trade position for the euro dollar. And similarly, back coming to October and November, just as the value of the dollar index peaked here, the value of the dollar yen peaked, we also saw the euro bottom here, along with many other currencies such as pound, USD as well, right? The pound dollar bottom around the same period. And as we saw price break through the 50-day moving average and also break through the bearish cloud, this would be signaling that, okay, technically this is a good entry position for going long on the euro, because we know the Bank of Japan has intervened in the open market. They're selling US dollars, they're selling US treasuries, they're buying the Japanese yen. And when you have a central bank, a major central bank selling the US dollar aggressively, it's very likely that the other pairs are going to rally against it, which is what we saw. So this is why we also see the crossover in price action for the euro dollar going above the 50-day moving average cleanly, breaking through the bearish cloud as well, and then proceeding to trade higher, going up to 1.1. Right. Similarly, if we had waited for the golden cross, this is a very good. This is the prime example of a golden cross. We would have missed out on this big move here from above the cloud as well. So that is why, once again, I reiterate, it's good to see the crossover points, but I would rather use the 50-day and 200-day moving averages together with the cloud to try and identify potential breakouts from a particular trend. So in this case, from the downtrend, we're looking for price to break above the 50-day moving average and the bearish cloud, stay above it, and then we can start to build the position. So likewise for dollar yen, similarly, as it broke through the 50-day moving average and it finally broke out of the bullish cloud as well, this would be probably a much better opportunity or time to enter the short dollar yen trades and build that trade rather than waiting for the death cross, right? Similarly here, instead of waiting for the golden cross, look at how price has broken through the 50-day moving average, broken out of the bearish cloud, and given the fundamental backdrop of intervention measures by the Bank of Japan, this would be a good time to initiate long euro dollar positions, right? So in terms of position trading, this would be a very good opportunity to build the long euro dollar positions. Okay. Okay. So, okay, building the strategy and putting into practice. So I've pretty much explained that in these various charts, right? Looking at the combination of economic data, such as US services PMI, composite PMI, manufacturing PMI, looking at inflation data, which is the core, I'm sorry, the headline CPI and the core CPI, understanding that ISM prices average tends to lead US inflation, and it's a very good measure tool to have to use, which you can build very easily in Excel. by going to the various websites that I showed you earlier, and also looking at financial conditions, right? As just to recap, as we have bond yields rising and the value of the US dollar rising, this creates tighter financial conditions, which is generally negative for equities. And then when we see them peak and fall rapidly, especially for the value of the dollar index, this means that financial conditions are loosening, which is generally a favorable environment for equities. Combine that with a rebound in activity here, in economic activity. So you have strong fundamentals as well for corporate earnings, and you also have looser financial conditions. All these two factors act as positive catalysts for equity prices. And then we also have the intervention measures taken by the Bank of Japan, which caused the value of the dollar index to peak and then crash through various indicators signaling a major reversal in trend. Similarly for the dollar yen and also for the euro dollar, right? So these are just to recap some of the themes we had in 2022. We had inflation accelerating throughout 2022 and started to peak and retreat from the third quarter onward. We had aggressive interest rate hikes by major central banks. We also had monetary policy divergence. Bank of Japan kept interest rates at negative 0.1%, while all the other banks were raising rates aggressively. We also had BOJ intervention that took place in October of 2022, which marked a significant pivot in trend for the value of the US dollar versus its peers. We also looked at how looser financial conditions developed despite elevated interest rates. And some of the, okay, we looked through this. And some of the themes for 2023 is, as we mentioned at the start of the year, there was a lot of AI-driven sentiment and hype, where we saw stocks like NVIDIA, I think, gain 200%. It's crazy. NVIDIA just gained 200% this year in the first 6 months of this year. And we also see continuing to see looser financial conditions, which have supported equity prices for now. And we are really seeing inflation decelerating, right? Okay, so if I just quickly end up by going to the value of the dollar index. Okay, maybe if we just look at NVIDIA, if you're trading NVIDIA, even trading the indices itself, so this is NVIDIA. Let's see, where are we now? This is 2023. Yeah, so after bottoming in October, right? You can see just nice in October as well. That's when financial conditions peaked and they started to loosen. You can see that translate into equity prices as well. And then as we entered 2023, we saw the huge demand and boom and hype surrounding AI-driven technologies. And that because NVIDIA being one of the only company that provides such chipsets for major AI players, we can see the demand for their GPUs and other cards skyrocket, and not only cards but services as well skyrocket. The demand for these products and services from NVIDIA skyrocketing, which naturally translates into better earnings for the company and of course share price action as well. So this big gap up here is because of the earnings that were announced by NVIDIA. You can see here they announced their Q1 earnings on 24th of May, where they significantly beat EPS and revenue estimates, which caused the share price to surge, and it's continuing to move higher. So the next earnings, Q2 earnings for NVIDIA, will be reported on 23rd August. Given that the AI hype is still intact, we still see a lot of demand for NVIDIA's GPUs and services. It's quite likely we're going to have another surprise earnings result from NVIDIA, which would likely to push its share price further higher, right? Okay, yeah, so this is how we can use a combination of identifying themes, tracking macroeconomic indicators, looking at central bank action such as raising rates, looking at central bank action such as interventions, and then looking at bond yields and the value of the dollar index, and using technicals such as the 50 and 200-day moving average, combine it with the Ichimoku cloud on a daily time frame, and try and identify major long-term trends, and also identify potential opportunities to build on that trend. So in this case, you can see here the 50-day moving average served as a good entry point to build that short position for the euro dollar. And similarly for dollar yen, the combination of the 50-day moving average and the cloud were providing opportunities for building that long position. Of course, you can combine it with your other indicators that you're familiar with, perhaps even more Fibonacci retracements or any other indicator tools, stochastics or RSI, to help to aid you in building that position. All right, just to end up. All right, so that's all for me for today. I hope this has been a great session for all of you. Before we end, we have a poll as well, so I really appreciate it if you could give your feedback on this poll. And there's also a short survey at the end of this webinar. We'll look forward to your feedback as well with regards to this webinar and any other future topics that you would like us to cover. And just before we end, I would have to go through a disclaimer again. So do take note that trading Forex and CFDs carry a high level of risk to your capital, and you should only trade with money you can afford to lose, right? Trading Forex and CFDs may not be suitable for all investors. So do please ensure that you fully understand the risks involved and seek independent advice if necessary. All right. Okay, thank you everyone for tuning in today. It's been a great session, and yes, just before we end, yeah, do take note. We have 3 major central bank interest rate announcements coming up starting tomorrow. All right. Thank you, everyone. Take care and have a great trading week.